Hi, how are you? I thought I'd just give you an update regarding the superannuation changes that are coming on the 1st of July 2017. Basically, there's quite a few changes. Some of them are quite sizable and complex. And look, some of these I did send through in a video back in September last year, but at that stage they were only proposals. However, now they have been legislated. So look, let me take you through the main areas, which are as follows. The first one is pre-tax superannuation contributions, or otherwise known as concessional contributions. From 1 July 2017, the concessional contribution cap will reduce to $25,000 for everyone. Currently, this cap is $35,000 for persons aged 50 and over, and $30,000 for individuals under age 50. So some changes here that are going to reduce the amount that one can contribute tax deductibly into super. On top of this, there has been a couple of other changes to the concessional contribution cap, and particularly, and this is a positive one, that individuals will be allowed to make contributions themselves personally and claim a tax deduction personally for contributions made to super. Whereas in the past, to claim a tax deduction personally, you had to be self-employed, whereas now employed and self-employed people can claim a tax deduction personally. Again, though, the total cap that will apply to all tax deductible contributions, be they personal, self-employed, salary sacrifice or employer contributions, is $25,000 from 1 July 2017. Also from 1 July 2018, so this is 1 year further out, any unused concessional contributions that an individual might have, they can be effectively saved up and used over a rolling period of 5 years. However, to be eligible for this, you need to have less than $500,000 in your superannuation account. Moving on to after-tax contributions, and basically from 1 July 2017, the maximum that a person will be able to put in out of after-tax dollars into superannuation, which is often referred to as non-concessional contributions, will be $100,000. Okay, so that's $100,000 for one individual, or for a couple, that's $200,000. The bring forward or 3-year rule will still continue to apply, and therefore effectively an individual can bring forward 3 times that limit in any one particular year, but then is locked out for that 3-year period from making further non-concessional or after-tax contributions. Between now and 30th of June, none of these rules apply, and therefore you can make contributions of up to $180,000 per annum, or bringing forward the 3-year rule, you can make $540,000 per individual to super. As a couple, therefore, you could theoretically make $1,080,000 in non-concessional contributions to super before 30 June. So this is potentially an opportunity for people to reassess as to whether that is something they should do prior to the new rules kicking in on 1 July 2017. One other thing with non-concessional or after-tax contributions is, once you have $1.6 million in your superannuation account, or maybe $3.2 million for a couple, you cannot make further after-tax contributions. Basically, you are frozen out of making after-tax contributions. You can still make concessional or tax-deductible contributions, but you will not be able to make additional after-tax contributions once you reach this amount. Another change that is coming in from 1 July 2017 is the tax treatment in relation to transition to retirement pensions. Basically, from 1 July 2017, anyone receiving a transition to retirement pension will have the investment earnings on that pension balance taxed at the normal superannuation tax rates of 15% on investment earnings, or 10% on capital gains held greater than 12 months. Currently, if any individual is in pension mode, there's no tax on their investment earnings within the superannuation environment. So this is effectively a change that means even though a person is receiving a transition to retirement pension, they're being treated as if they are in normal super or accumulation phase where the normal superannuation tax rates apply. Accordingly, people have choices of either to cease their TTR pension or to convert it into a full retirement pension by satisfying a condition of release, such as retirement or changing employment if aged over 60 years of age. And the other option is for them to continue the pension on in its current form. Another change that was put into legislation is the tax on concessional contributions for high income earners. So in the past, if someone earned over $300,000, their concessional contributions, being typically employer contributions and salary sacrifice contributions or self-employed contributions, would be taxed at 30% instead of the 15% contributions tax rate. From 1 July 2017, this additional 15% tax will apply for all individuals whose adjusted taxable income is $250,000 and above. So it'll capture a lot more people in the net, so to speak. Probably the biggest change coming on 1 July 2017 is the $1.6 million pension transfer cap. And basically the main thing with the pension transfer cap is that an individual will only be allowed to transfer $1.6 million into pension phase, and any excess amount over that must stay back in superannuation or accumulation phase. Now, what does this mean? It basically means that you can have $1.6 million in pension phase, paying therefore a zero tax rate on the investment earnings within super. Any excess over that $1.6 million still can be kept inside super, and generally that is still the most favourable thing to do, but it will be taxed at the normal accumulation or superannuation tax rates of 15% on investment earnings. The 15% on investment earnings is still only applies to the excess over 1.6 million, and it's typically still more favourable than the marginal tax rates that exist outside of super. So as a general rule of thumb, it's still potentially more beneficial to have more money than that cap inside super, except in limited circumstances, and this needs to be addressed on a case-by-case basis. Now, it's important to note also that the $1.6 million cap is the cap that applies to each individual. So for a couple, technically they could have $3.2 million in pension phase and have a zero tax environment on those investment earnings. And again, you can still have over this cap. You could have $5 million or $10 million in super if you so wish, but the excess over the $1.6 million cap per individual, or $3.2 million for a couple, will be taxed at 15% on the investment earnings. Now, as at 1 July, basically every person in pension mode who has over this $1.6 million cap will need to move the excess component back into accumulation mode, and the government has announced some transitional rules in relation to capital gains tax. Typically for self-managed super funds, it's quite flexible, and we can make decisions on that very readily and post 1 July 2017. For individuals that are in retail superannuation accounts, they will have to take physically some of those assets that are over and above the $1.6 million cap and transfer them back into superannuation or accumulation mode. As a result, that is what these transitional CGT rules are about, where effectively they won't get taxed on that, on selling down of any assets that may need to occur to move back to accumulation mode. So look, this rule of $1.6 million cap, it is very similar to the reasonable benefit limit rules that existed back in the late 90s. It is going to be complex to administer, but it is something that really, once you get past it, you need to understand that it's still better to have more in super than these caps if that's possible. The reason for that is, again, simply up to 1.6 million will be tax-free each inside super. The excess is only taxed at a maximum of 15% on the investment earnings. So an example I would probably give to you is if you had $2 million inside super in pension phase, then what you'd find is 1.6 million of that would be zero tax rate to apply on the investment earnings. Only the $400,000 that is above the cap at the date you move into pension mode, or in this case 1 July 2017, will be taxed at 15%. So if you earn a 5% income return on that excess of 400,000, you're talking about 20,000 worth of investment income, and the tax rate that applies on that would be 15%, which means the tax on the earnings would be around $3,000 less any franking credits. So look, $3,000 as tax payable on a total investment portfolio of $2 million is still very economic, is still very efficient. Some other more minor changes that have come through effective 1 July is the government co-contribution can still be claimed, however, only if your account balance is below the $1.6 million cap. The other change has been to anti-detriment provisions, which is basically if you died, potentially you're able to claim back up to 15% of the tax that has been paid on your contributions over time. So this will cease at 1 July. Look, it's not something that a lot of people know about, and only applies in certain circumstances, but that will be removed going forward. So look, I hope you found this useful. As ever, if you've got any questions, just let us know. Obviously, these changes are going to make superannuation more complex, and so we're here to help you walk your way through these rules over time. We still believe superannuation is very tax effective. We also believe that it is still the best vehicle to accumulate wealth. The trick is now it's getting harder and harder to get money into superannuation, and that's why it's important to get as much in as soon as possible. So look, I hope you found this useful, and as I mentioned, feel free to contact us if you have any questions. Cheers and bye for now.